But shifting our focus to a rare and exclusive conversation, and this one is, of course, coming in with the fund-to investor himself, Sanjay Bakshi, in conversation with Nikunj Dalmia for his first ever TV interview.
There is a word which is gaining more and more, center stage now, which is value trap. How would you define value traps?
Value trap to me means something that is tempting the investor to buy but should be avoided. So it looks cheap on a mathematical sense. If you look at the numbers, it looks cheap, but it is likely to remain cheap. And for all sorts of reasons. And one big part of the reason is misgovernance. At the end of the day, the stockholder of a company is a minority partner in a business which is run by other people, which is in control of other people. And if those people run it like a family business or run it in a manner which is not really in the interest of the minority shareholders, and the market knows it, then it would obviously be selling at what appears to be cheap, and it is actually cheap, but it's cheap for all the right reasons. So value traps are things that are cheap, but are cheap for the right reasons, which means that they are likely to remain cheap, and therefore an investor should try to avoid them as much as possible. The basic idea is to look for things that are cheap but are cheap for the wrong reasons. And those, I think, are not value traps.
How much importance do you pay to macros while investing? Buffett, for example, has always said that, look, I don't care about macros. I've invested at the peak of macro pessimism. So for a value investor, factors like interest rates, fiscal deficit, currency movement, GDP growth, how relevant are they?
They may be relevant for a lot of investors. I don't have a problem with that, including value investors. I don't do that though. I am more of a microeconomic investor than a macroeconomic investor. Basically, I focus on three things, three subjects, so to speak. One is accounting, which is the language of business. You got to know that to understand financial statements and how to analyze them. And also to understand the process, how the financial statements are prepared, and how these three statements talk to each other, the P&L account, the balance sheet, and the cash flow statement, and so on and so forth. That's accounting. The second is microeconomics, how businesses make decisions, how prices are set, what is the difference between perfect competition and an iconic brand, and the whole spectrum around it. And the third is the overlay of social psychology, because if you study economics, they teach you that humans are rational and firms are rational, but actually, if you think about it, if you look at the real world, they're often not that rational. Often dumb things happen. Capital misallocation does happen all the time, and sometimes the price of a commodity drops below the cost of production, at which time it's rational to shut down, but people don't shut down for all sorts of behavioral reasons. Those come from the field of psychology. So if you combine these three disciplines, microeconomics, social psychology, and accounting, for me, I know I don't need another subject. Macroeconomics is a subject which has a lot of variables, a lot of moving parts, and I think it's very, very difficult to predict the outcome of exchange rates or interest rates, and whole lot of other factors which go into the macroeconomics field. And as a student of Buffett, I have also stayed away from making a lot of macroeconomic analysis while making judgments about businesses that I want to invest in.
Professor Bakshi, while the rules of value investing you alluded to do not change, but circumstances change. When Graham was coming with his investment philosophy, it was based on intrinsic value because world was recovering from world wars. Buffett was able to ride on the theme of build America by buying companies like Coca-Cola and American Express because they had a moat of consumer monopolies. Similarly, some other famous investors have also invested in companies in tech and perhaps in AI because that is where the world is moving. So do you see that things in a sense would evolve and change, and the rule of value investing would also change because the future growth industries are dynamically different?
Absolutely, yes. You have to keep an open mind. The world has moved away from asset heavy businesses to asset light businesses. businesses which don't have a lot of tangible assets but own a lot of brands and intellectual property. They have the ones which have actually made all the money. But that was not the case when Ben Graham was writing his books or when Buffett started his career as a value investor. So this whole concept of buying something below book value has already evolved. You know, people don't look at a discount to book value, except in certain industries like financial stocks. They don't look at book value as an indicator of intrinsic value anymore. So that evolution has already happened. But while that evolution has happened, I think those three first principles that I highlighted earlier have not changed. You know, it's just how you apply those principles. So at the end of the day, the value of a business is the present value of future earnings. If those earnings are coming from very little tangible assets, then obviously that is considered as very favorable right now. In some cases, earlier on, you needed to have heavy industries and heavy investment in capex, which was considered to be a great thing. Again, these things evolve over time, and I think I don't have any hesitation in saying that how this will evolve, I can't predict because I'm not in that game, but I do know those three principles are not going to change.
So, Professor Bakshi, now looking at the track record of India, we can identify perhaps some good businesses, whether it is Asian Paints or whether it is some great private banks. We can also look at the reasonable amount of corporate governance which is present there because they are audited by big firms. We can perhaps also look at the vision of the promoter because it is available on blogs, it is available on balance sheet. But sir, ultimately it comes down to valuations and how do you value and what is the right price of a business. So how does your framework really identify that you're buying a good business at a reasonable price, valuing the business and finding the right price? How does that work for you?
It's a great question, Nikunj. I wish I could do a whole course on that and actually do that. Uh, um, so let me try to simplify the problem. You see, the original concept of margin of safety was that the value is more than price, and you were actually trying to estimate what that value is. Over time, people have realized that when you try to estimate value, you have to make elaborate predictions about the future, and then you get into that gaming, and then you get into that goal seek, and there are so many variables, and you are over optimistic, and you can change a few assumptions, and you will get the value that you want. So to deal with that, I felt that Graham also, by the way, talked about it. He said in his books that you could either explicitly try to figure out what the value of a business is on a per share basis, and then look for a big margin between that value and the price that you're paying. That's the source of margin of safety. But he had a second definition, which was that I don't know what the value is, but I know the value is a lot more than the price that I'm paying, and the indicators in that direction are high earnings yield on the price that I'm paying. So if you take normal earning power of a business, adjusted for abnormal factors as a percentage of the price that you're paying, that number should be a way more than, let's say, bond yields. Or a big part of the earnings are being paid out as dividends, and the dividend return alone on your initial purchase price is not very far from the bond yield. And when you do that, especially in a high quality business, when you use these valuation principles, or not just valuation principles, I should call them as finding misprice opportunity principles, with the quality dimension that we have picked up from investors like Buffett or Munger and so many others out there, then you start, when you combine these things, you find that there is a business that is growing. It's a very strong balance sheet. It has a moat around its economic castle, and the earnings are going to grow over time. But at the same time, you can buy the stock of this company at a valuation with the earnings yield as a percentage of the stock price is more than twice of AAA bond yield, or the dividend yield is similar to what you could earn in a fixed deposit. Then you start, if you do the math, you will figure out that you're not really paying anything for the growth component of value. Therefore, you start treating growth component of value more like a lottery ticket. If growth happens, then you have very strong belief that it will occur. You're not paying anything for that, so that will make you money. But even if that doesn't happen, you can't lose, because the price that you're paying is so low that the current earnings of the company are more than sufficient to explain more than 100% of the stock price. So that method, which I talk about in various case studies in my class, I think is very interesting because it helps you skirt away from the more difficult question as to how much is this value, how much is the value of this particular business on a per share basis, and sort of nudge you towards an easier question to answer, which is it likely to be worth a lot more than what I'm paying? And that's margin of safety too. The comfort that the value of a business is likely to be worth a lot more than what one is paying is sufficient source of comfort, provided one also has diversification. So when you combine this style of seeking margin of safety with diversification, you really are able to implement those three ideas that we talked about earlier without making any change in those ideas. You can evolve into investing by using value investing principles in the valuation methodology that I mentioned to you.
Well, so you've really given this framework in a very simplified manner. My last couple of questions, I'll take the liberty of extending my appointment with you. It's the first time, so I mean, I'm really excited about your thought process and what you're sharing with us. You look at the history of a company to judge the durability of the business, because the business has to be durable so that it can go through the twists and turns which happened because of, let's say, great financial crisis, or they've happened because of COVID. But when it comes to some of the new companies, and I'm using, let's say, Zomato as an example, or Policy Bazaar as an example, these are new companies, but they've created terrific wealth. So as a value investor, would you give a no-go to companies which right now are small but have potential to become big, companies who are loss-making right now and have no cash flows? Would you give this entire category a skip?
I wouldn't, but that doesn't mean that you shouldn't or other value investors shouldn't. In fact, there are a number of respected value investors, including Indian investors, who have done extraordinarily well by investing in businesses which don't make a lot of money right now, or which may actually be losing money, but which are likely to make a lot of money going forward. I'm going to miss all of them. Basically, and I'm okay with that, because what that means is that I'm going to have a lot of errors of omission. What I don't want to have is errors of commission, and I have had my share, no doubt about that. You can never have zero rate of error, but you try to minimize when you try to minimize the errors of commission, you're naturally going to have to settle for a lot of errors of omission. You will not buy. So for me, in new age companies that haven't been around for a long time and have not already become very profitable is not something that I would be interested in. That doesn't mean that other investors are wrong when they're investing in it. It's just not my game.
Actually, a word which I've learned from you, and I must say that I use it seamlessly on television, and I'm also trying to incorporate it in my personal life, which is the whole idea of stress-free investing. It's a new concept. No one talks about it, but I guess that's the most important idea when you are taking risk and when you are doing value investing. Can I urge you to request? Can I request you elaborate on it, sir?
Sure. So many years ago, I was, we all have learned about the idea of trying to maximize the upside by minimizing the downside. So we talk about upside downside ratios. We look at risk reward ratios. So we keep talking about returns per unit of risk. And risk is defined in many ways. Some people associate with permanent risk of permanent capital loss, which is the way I think about it. Some people think about it as volatility, which is the way the academic finance thinks about it. But at some point of time, while I've had a long journey as a value investor, so I used to do F&O trading, and I had a miserable experience doing that. It was very stressful. I used to use leverage in buying stocks. I used to have this loan against share facility from banks, and I would borrow money to buy stocks, and that was extraordinarily stressful for me. I got involved in a couple of activist transactions. While I did well financially, but I think the body took a lot of stress. It's very stressful to do a lot of things. So I figured out a while back that there are all these things in your endeavor to create wealth which could actually be not good for your physical health. So you might make money, but it's not good for you. And we all know stress is a killer. Stress is a very important contributor for mortality. So, and there are all sorts of things in the field of investing which are highly stressful. Day trading is stressful. Shorting stocks is stressful. I think activism on reflection now, I think is stressful. Getting into derivatives is stressful. So basically, what I figured out that if you could avoid doing very stressful things and still find a way to compound your wealth at a satisfactory rate, then you will not only achieve the financial independence that we as value investors try to accomplish, but also be able to do it without compromising on our mental and physical health. If you could do that, then I think it makes more sense than just only focusing on maximizing your returns.
So true, important, and we, I guess, really need to circle our thoughts around the importance of health and what stress can actually do. But my last but one question, and a common term which is often used in stock markets is next multibagger कौन सा है, अगला HDFC बैंक कौन सा बनेगा, अगला Infosys कौन सा बनेगा. Everybody wants to identify a multibagger. Can you identify a stock at its incubation stage, at a nascent stage, that this will be the next multibagger? Is it possible?
I think it is possible, but if you only try to do that, that's not a great thing to do. You see, a lot of people talk about how much money they made in a 100-bagger, but they put hardly any money in it. It's not just about the percentage gain on your purchase price. It's also about the weight. If a stock delivers you, a 15% return per annum, and you had a lot of money behind it, and you held it for 10 years, you're going to make more money than a stock that went up 20x, but you had hardly any money invested in that. So what matters is how your portfolio does over a long period of time. So instead of, again, goes back to the casino side of the stock market. There is this element, there is the investing side, which is like people are treating it as investment in businesses, and as they become more valuable over time, their wealth will increase over time. On the other end, we have day traders, and somewhere in between, we have short-term investors who are buying stocks, but they expect too much from them and they want to get rich quick. The moment you move away from viewing the stock market as a place to get rich quick, but to just view it as a place to invest in a business or a bunch of businesses run by really good quality people, bought at reasonable valuation and holding on to them, the problem becomes far different than the problem of a day trader or a very short-term oriented investor, because you don't need multi-baggers, to be honest. As I mentioned, India is a growing market and there are so many more companies that are coming to market. If you can compound your wealth at a rate which is a lot more than what the FD rate is, I think that's good enough. That's going to make you rich over a period of time. And while accomplishing that goal, you may end up with not a single stock that was a 50x or a 100x. So my answer here is that you don't need multi-baggers, but by multi-baggers, I mean, 20, 30, 40, 50x. But if you do get them, then obviously it's a good, it will obviously contribute to your overall returns. But important thing here is to understand the mathematics behind a 100-bagger. A 100-bagger is something that went up 10 times and it went up 10 times again, and you haven't sold it. And think about how difficult it is for somebody to see a stock become 10x its purchase price and he still held on for the next 10x. That almost never happens. So when we talk about these multi-baggers and the desire for these multi-baggers and the contribution toward overall returns, it's far easier, I think, to implement a strategy of expecting reasonable returns from your investment in a bunch of businesses, exactly what Ben Graham taught us, and not just chase the casino side of the stock market where you're trying to get rich quick by investing in multi-bagger that will go up like 20, 30 times in a year or two.
Professor Bakshi, I'm sure this question has been asked to you several times, which is that, oh, you started in 1980s and markets were not efficient. It was easy to make money because markets were not efficient. Today, markets are efficient. They're very well researched. The inefficiency of the market is over. So it is impossible to see the kind of return what Indian markets have seen. Is that true?
No, I don't think that's true. You see, the presence of short-term players in the market actually increases volatility. And increased volatility, which means by definition, if the business values are not changing much, but the prices around that business are changing a lot, then that will produce opportunities. So it goes up a lot more than it should. You can, if you want it, you can get out of that and replaces something that is much cheaper. If it goes down a lot more and you don't own it, you can buy it. If you own it, you can buy more, and so on and so forth. So the fact that there is more information doesn't mean that the markets are more efficient. As I mentioned earlier, the noise to signal ratio has gone up, and therefore the cacophony around a business has gone up a lot. Uh, uh, and that doesn't mean that investors who have the ability to ignore the noise and focus on what really matters, they cannot, they cannot uh, use the stock markets as a way to compound their wealth over a period of time. The moment you start approaching it as a business opportunity, not as a market, analysis opportunity, it looks very different. I think that's not going to change. That opportunities will keep existing, I think.
Professor Bakshi, I'll just summarize it with one final question. And I'm sure this is also one question which you've addressed in the past, but just for the young audience, if you could address it. And the question is that, okay, I want to be a true value investor. I believe in the power of compounding. I genuinely want to think in terms of years, not days and weeks. But my starting capital is so low that how can I really benefit from compounding? And that's a very common question. Look, I'm starting with the bare minimum. I am finding it difficult to meet my ends. So even if I start and believing and implementing compounding, I don't have capital. How does one address that question?
So that's a great question. It's a very simple mathematical answer. And the answer is that you can't do it unless you had a source of income which you could save substantially and allocate that over a long period of time towards investing in well-selected equities. That's one way of doing it for a person who is working and has a second income. And for a person like me, when I started, I had to go to my family to raise capital, and some friends of mine who contributed some money. Basically get other going to end up with certain amount of corpus 20, 30, 40 years from now, and you have nothing right now, then you can't just use this number to get to that number. You have to keep adding to that to the earning stream that you're going to have. To be able to do that, you either need a second income, you need a source of income which is available to you, which you're massively underspending. You're just allocating a lot of money, which is what I teach my students, that don't get tempted by credit cards and new clothes and new homes and cars and stuff in the initial period of their life. All the savings should go towards investing in equities. And of course, for a person who wants to be a professional value investor, the idea is to raise money from somebody who would trust you in your early years and give you access to OPM, which is other people's money, which you can compound and earn a return on that. Of course, you need to get the required SEBI registrations and so on and so forth. But I think that's the only other way you can do it, because there is no other way. I mean, you can't. So if you have nothing, almost nothing, and you want to end up with a few, crores of rupees, maybe a few years from now, if you don't follow these two methods, you will be tempted to do something really foolish, like what people do when they walk into a casino. They put their number on a roulette at a single number because it can give you 36x. So you get attracted towards the so-called multi-baggers. You will get attracted towards influencers. You will get attracted towards the casino side of the stock markets than the investing side.
All right, some invaluable lessons there, and that's a one-of-a-kind interview with Sanjay Bakshi.
If you like this video, then like, share and subscribe to ET Now.